Hello friends, this is Vijay Bhambwani here and I'm back again in my weekly market outlook video to discuss how the market is likely to be in the coming week. Now in this video, I'm sharing with you a lot of our in-house studies which you won't find elsewhere, and we are going to see who is doing what in the market that's likely to impact our decisions in the market as they were. So the markets continued to rally, powered by the retail enthusiasm. We'll see later on how retail traders are single-handedly lifting markets higher, and coming up on your screen is the weekly market roundup window. Note how banking stocks surged. And this happened primarily on Friday, which took the Bank Nifty to an outperformer, a relative outperformer status as compared to the Nifty 50. And bullion saw a mild pullback after a steep fall in the recent past. Now, the worrying part which I see on this market roundup is the oil and gas prices, which have shown a decent run up. Now, I've been telling you in the past videos that these are what I call multiplier commodities because they trigger inflation. Everything from fruits, vegetables, meats, eggs, everything basically become more expensive once oil prices go up, and this results in what economists call imported inflation. So we need to watch this area of the market fairly keenly. The US dollar index fell, but the USD INR rose marginally, which means the dollar index vis-a-vis the global basket of currencies was weak, but the Indian rupee was relatively weaker to the US dollar, which makes the Indian rupee relatively underperformer as compared to the US dollar. This is contrary to what has been happening in the last few months, where the rupee has been stronger than the dollar. So we are going to take this as a one-off corrective kind of a move, but we'll have to keep our ears to the ground for this development. Now, bond yields were steady, and as you are seeing on your screen right now, the market-wide position limits fell, which is a routine phenomena after expiry, because people do tend to unwind a lot of their exposure on expiry day. Slowly but surely, this MWPL continues to rise till the third week of the new derivative cycle. So this fall is kind of routine. Now, check out the basis chart on your screen. It's nothing but the premium enjoyed by the futures over cash. Now, there was a sharp jump on Thursday, which is again routine because the new derivative cycle kicked in of July, and traders have 1 full month, 4 weeks to play ahead of them, and therefore they are willing to bear a higher premium cost. This applies to both options and futures premium, and as time goes by, this premium is likely to ease lower. Now let's take a look at the cumulative series July, August and September futures series volumes of index and stock futures. Now they've plunged very sharply on Friday, which was a very bullish session, mind you. Now such poor volumes show an absolute lack of buying conviction at higher levels. And it's not just the base effect of Thursday being an expiry session, which is why the volumes were very high, and Friday being a regular session, the volumes have fallen. No, it's not that. As a matter of fact, you can see on the Nifty that the volumes were higher for 2 or 3 sessions prior to this also. So the conviction at higher levels was missing. I think we need to watch this space very keenly in the coming days. Now, here comes the impetus chart, which is again our exclusive in-house study, which you won't find anywhere else in the public domain. Now, this shows a mild revival in momentum in the latter part of the week. It's early days yet, and follow-up buying is needed to signal a sustained up move. However, there is an undeniable improvement, however slight it might be. So let's hope that the bulls continue to lend support and the impetus improves. Now let's take a look at a very popular metric which I've introduced recently, again which is an exclusive study from our in-house statistical model, the Barracuda. Now this study basically measures and gauges who's buying and just how much. The first chart on your screen is showing the FII exposure, and the FIIs have raised their index futures net long positions to 79,486 lots from a previous weekend of 41,364 lots. Now, where stock futures are concerned, they are now net short marginally, that too by 338 lots. Whereas in the week prior to that, they were net long to the extent of 10,184 lots. The FIIs clearly seem to be cautious from their trading activity. Now let's take a look at what the prop traders are doing. Now these guys, the prop traders, are brokers and specialists who are highly clued on as to which way the market winds are blowing, because they are empaneled as brokers with institutional players, etc. And they're very well networked and connected in the markets. Now, the prop traders are showing optimism, as can be seen from their stock and index futures exposure chart. Note how they've reduced their exposure for expiry, which was on Thursday last, which is routine, and they've stepped up their exposure again on Friday. Now, let's check out the retail footprint. Now, this is very interesting because the retail has raised their net short position on the index futures to 26,990 lots from an earlier weekend of 8,087 lots. Simultaneously, they've raised their individual stock futures long exposure to period highs, and they are now responsible for long positions in the stock futures segment, which is 6.5 times bigger than both the prop traders and the FII players combined together. Now clearly that shows that the retail traders' actions that are making or breaking the markets. They continue to remain optimistic, and do note that I update these three charts of the FIIs, prop and retail traders daily late evening on my social media pages. So I think you can very well update yourself every day by connecting with me. My contact coordinates will come at the end of this video. Friends, let's now take a look at the 10-year benchmark bond yield, which is very critical. It's been over 8 to 9 months since I've been telling you that bond yields are extremely crucial, even if you're not trading or investing in the bond market, but you want to trade the Nifty, Bank Nifty or banking stocks. You must pay attention to bond yields. Now the bond markets were flat all of last week. Now yields on the 10-year benchmark bond yields were range bound between 6.01 to 6.02%. That's how close and tight the range was. The RBI had its way of providing stability in the yields. However, the Business Standard, now this is a newspaper that I used to write guest columns every day for 9 years between the year 2000 to 2009. Now the Business Standard reports that the RBI did not buy rupees 14,000 crores worth of 10-year benchmark bonds in spite of paying underwriting fees for this issue. The report points towards a possibility that the bidders were asking for far higher interest rates. Do remember, I've been updating you of the fact that the RBI needs to raise 12 lakh crore rupees from the bond market in this financial year as per the budget. Now, with 1 quarter of the year gone, nothing has been done yet, which means there is a possibility of a new series of bonds which may be launched very soon. Now, whether the coupon rates, which is the interest rates on these bonds, will be tweaked or not is a matter that the RBI is keeping very close to its chest. Keep watching this aspect, especially when the RBI meets for determining interest rates in August. The Monetary Policy Committee will meet in August. This will impact all asset classes, including equities. So you must pay attention to the bond yields extremely keenly. Friends, let's now go to the DXY, the US dollar index, which is the currency benchmark of the United States dollar versus the global basket of currency. This benchmark index rose on 3 out of 5 trading sessions last week, and these 3 trading sessions happened to be the last 3 days of the week. The index still closed with mild losses though, and the price remains above its 25-day exponential moving average for now, which means the short-term outlook is positive. Note the weekly chart, which shows a bearish candle which is still too small to be called a valid piercing candle. The price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive, but for now. The 91.5 level remains a support to watch out for in the near term, and the 93.5 will act as a resistance on the upside. With oil and gas prices rising, watching the index, the DXY index, becomes very critical. The last week I advocated a range between 93.35 on the upside and 91.10 on the downside, which held perfectly well. The coming week will witness an estimated, I repeat the word estimated here, an estimated range between 92.95 on the upside and 90.75 on the downside. I suggest you watch this index keenly. Friends, let's now go to the Bank Nifty, the second most liquid counter in the derivative space on the NSE, and this index rose on 3 out of 5 trading sessions last week, but managed to outperform the Nifty 50 after a very long time. The price is back above its 25-day exponential moving average, which means even the near-term outlook is now turning positive. The recent swing high at 35,810, which was made on 4th of June 2021 in the cash segment, needs to be overcome to confirm a breakout now. The recent low of 33,937, which was made on 26th of June 2021, which is last week, should hold in case of declines. The bulls must be able to defend this threshold if they are keen. Now watch the daily chart on your screen. It shows a bullish engulfing pattern, which basically shows the bullish candle has overpowered the previous bearish candle. The price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive. In the week before last, this index was number 4 on the most volatile list, where it stayed even last week. I advocated a range between 36,150 on the upside and 32,950 on the downside, which held perfectly well. The coming week is likely to see an estimated, I repeat the word estimated here, range between 36,950 on the upside and 33,775 on the downside. Friends, let's now go to the Nifty 50, the most liquid, the lowest impact cost counter on the NSE derivative space. Now let's take a look at the Nifty daily chart on your screen. The index rose on 4 out of 5 trading sessions, but still underperformed the Bank Nifty relatively, due to the big rally in the Bank Nifty on Friday alone. It's now within a whisker's distance away from the psychologically prominent 16,000 round number, which the market seems to be watching out keenly for. Now the price stayed above its 25-day exponential moving average, which means the short-term outlook remains positive. The exponential moving average will provide support at the 15,500 mark, which is where a lot of put options have been written, and the bulls will have to defend this level in case of declines, if any, in the coming week. Note the weekly chart on your screen, where a bullish engulfing pattern is seen exactly like the Bank Nifty itself. The price remains above its 25-week exponential moving average, which makes the medium-term outlook positive as usual. Now crossing the Rubicon of 16,000 and staying above it should trigger short-term bear covering, which may also induce higher beta or volatility. In the week before last, this index was number 22 on the most volatile list, but it rose 3 notches to go up to number 19 on that list, which means that the price, intraday price action is now getting more and more choppy. Last week, I advocated a range of 16,150 on the upside and 15,200 on the downside, which held perfectly well in spite of all the volatility. The coming week is likely to see an estimated range between 16,325 on the upside and 15,375 on the downside. Now, the Jensen's measure has reported a marginal improvement in the odds for buyers, though it's not a screaming buy level conviction. So things are marginally improving for the bulls, but I would suggest you keep trading very guardedly, very cautiously with stop losses in place so as to avoid any shocks to your capital. The indices done, my friends. I now come to the most popular part of this video, where I give you 5 stocks which are high volatility, high beta, high impetus counters, where you take small exposure and wait for big price moves. And I give you 5 more stocks which are low volatility, low impetus, where you take big exposure and you wait for smaller price moves. Now, like I told you in the beginning of the video, the turnover on Friday really collapsed. Now, this was a day when there was very little movement after the indices opened higher. The prices, almost all major stocks opened higher, so the index was positive, but thereafter they traded in a very narrow range. What do you do then? Then you trade low beta, low impetus stocks, and when the market is really buzzing, when the prices are really moving up, take the high beta, high impetus stocks, where you take small exposure and wait for big price moves. So the high beta, high impetus stocks list is led by Aarti Industries at number 1, Bharat Electronics number 2, number 3 Naveen Flooring, number 4 Indraprastha Gas, number 5 Titan, and the low beta, low impetus stock list is led by Bata at number 1, number 2 Bharat Heavy Electrics Limited, number 3 Dr. Lal's Pathlab, number 4 Bajaj Finance, and number 5 Adani Ports. Do note, my friends, that this list is highly dynamic and volatility moves from day to day. Therefore, the hierarchy of these stocks can change every day. Do connect with me on social media to update yourself about these aspects in the late evenings every day. Friends, if you liked this video, I would appreciate it if you would subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know what you think of this video. And in the description below this video are links to Equity Masters YouTube channel, where I put in 4 videos every week. I would appreciate it if you would subscribe to my playlist there, where I share a lot of ideas. There is also a hyperlink on how to get a free trading guide, how to become a better trader using that trading guide from Equity Master. So I hope you have a very, very profitable week ahead. I thank you for your patience and watching my video. Till we meet again in my next weekly market outlook video, do take very good care of your trades, investments, health and family. Vijay Bhambwani signing off for now. Thank you for watching. Take care. Bye-bye.